Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and in the weeks ahead. Today I'm joined by Alvaro Vivanco, who is our head of ESG and emerging markets strategy over in the US. Alvaro, we have been on tour the last few weeks, basically marketing our year ahead outlook for 2024 and what the implications are for emerging market FX. We have quite a counter-consensus view. So I'm wondering, what is the main feedback that you're getting from clients?
Hi, Eimear. Yeah, it's been super interesting just sharing views with clients over the last couple of weeks. And for emerging markets, it's a little bit all over the place, to be honest, which is actually different than what it had been the case over the past few years. And maybe, it's a good thing, but clearly it's a reflection of a lot of the uncertainties that we still have in terms of inflation globally, how each country is going to have the sequencing of rate cuts at the developed market level, and then how those be translated into emerging markets. But essentially, I will say that there's two main camps. The first one is that even though the Fed is likely to ease rates next year, and that should be positive for risky assets, emerging markets is seen as exhibiting some weakness, especially in terms of carry, right? Which is basically our proposition, that carry to volatility has already started to decline for most emerging market currencies, and that will continue into next year because EM central bankers have the capacity and the willingness to cut rates as their own inflation has moderated quite a bit, and they have kept rates high for a long time. And now that the Fed and the ECB is moving in that direction, that they could actually move a little bit more and more aggressively than the Fed. And that makes us and a few of our clients a bit more defensive on just chasing the carry trade, given that positioning in some of these currencies is already quite high. And then on the other side, we have had quite a bit of pushback that basically says if rates globally continue to moderate and the market really believes there's a story of the Fed and the ECB easing rates into next year, this is going to be something that helps all risky assets, and emerging markets will benefit from that. And they basically see the fact that yields are still quite high in nominal terms in a lot of these currencies as kind of the main drag, the main attraction for them to continue. What we all agree on is that there is a lot of uncertainty of the timing of when these transitions between the Fed and EM central bankers will take place. But at the same time that EM fundamentals are not particularly strong, especially in terms of growth, right? We've seen that the vast majority of countries will still be growing at a lower pace compared to the pandemic. But at the same time, we don't think that there are any kind of big negative surprises that are likely to kind of cause major dislocation in emerging markets. We see it more of a gradual process that as carry continues to decrease over time, people are already long emerging markets, that they will start to take those bets off the table, and that the dollar will continue to do well into next year. That's mostly what we're hearing from our clients in the US, but you have also been traveling in Europe even this week. What are you hearing from your side and related to your CEMEA countries?
Yeah, I think it's interesting that, the consensus out there seems to be that it's almost this formulaic kind of reaction of EMFX, that effectively you'll get the Fed cutting, you'll get inflows into EM, and you'll get a risk rally and into bonds as well. But I think when you lay out the arguments that, this time is different, it's a very different external environment for emerging markets that they face when you have kind of China, that's not going to be the driver of global growth, but also just extremely high US yields and kind of what that means in terms of competition for global capital, and also just elevated debt to GDP among these countries that, investors can't easily kind of dissuade that argument. So you are able to convince some people. I think there is kind of world consensus on a few of the top picks, such as Mexico and India, which investors seem to be that they have chosen their favorite longs in the EM complex. And I know, since we put out the report, things have changed a lot in terms of moves in ES yield. Has it been enough to kind of change your view?
Yeah, it's been really interesting, right? Because we had this rally in US rates that we as a team were expecting, but it has happened certainly quicker and earlier than we anticipated, right? And to some extent, we feel that the market might be getting a little bit ahead of itself, and that over the next few weeks, it will be difficult for this rally to continue as we start to hear from the central banks and especially the Fed, and maybe they want to, put a little bit of the brakes on the market, pricing in and pushing them too hard into easing, even if that remains the base case. But I think just the fine tuning of the policy and the fine tuning of the communication until then is gonna be more critical. What has been a little bit surprising is that EM has done relatively okay, but we're starting to notice lower correlation between appreciation of the currencies and just US yields, right? That we have days in which we definitely see the sell-offs of EM when rates are under pressure, and they don't are fully balanced by rallies when rates are rallying. So I think that, just again, the fact that levels in a lot of these currencies are pretty stretched, going back to the highs against the dollar that we had a couple of months ago, the positioning is already quite high. Some of these concerns about debt that you have mentioned, starting to at least become questions that investors are raising, has lowered kind of the beta and the sensitivity of emerging market, and I think that that's really important, right? It's just at a minimum, it's going to be a lot harder for emerging market currencies to continue to rally, even if the global conditions remain okay. And I think another factor is just kind of questions and themes pivoting also towards growth, right? That if we're not going to have the carry from emerging markets, are we going to get some positive surprises in terms of growth? And we're definitely not seeing that, right? In the vast majority of cases, actually, things have deteriorated. The other thing, and one of the questions that I'll pass to you, is kind of the reaction of central banks in emerging markets, right? In that time, not that much has happened. Everybody has sticking to the same pace and the same language. But in your region is where you're seeing a little bit more of the defensive stance. Do you expect that to remain in place? Is it a reaction mostly to how the currencies were selling off? And, does that change your view over the medium term?
Yeah, I would say, what comes to mind is definitely Poland, which basically kind of halted its easing cycle, back in October in the aftermath of the parliamentary election. We think that really is kind of more idiosyncratic, that it really represents kind of fiscal concerns there. We did have the National Bank of Hungary that really moderated its pace of easing, but it's still going at a sizable clip of 75 basis points per meeting. So it's a significantly really chipping away at carry. And in terms of what you're saying about, lower back end US yields, I think one thing that really speaks to me is that we have had, the biggest easing in global financial conditions in the month of November in about 20 years. And yet, Hungarian forint is flat on the month. South African rand is down on the month against the dollar. So all these kind of high beta currencies you would really think would be the biggest and the first beneficiaries of an easing of financial conditions just haven't been. So I definitely kind of agree with that view that this time is different, that it's not a formulaic kind of responsive markets to go back into EM. I guess kind of looking further ahead now, what do you think are kind of the emerging big themes as we go into the turn of the year?
Yeah, something that a lot of clients have been asking us about, besides all these, macro fundamental stories, is elections, right? And kind of, I guess, when we are all looking at the year ahead, we realize how many elections there are in the U.S., in the U.K., in Taiwan, India, Mexico, South Africa. The calendar is very, very heavy with a lot of potential surprises out there. And this is a big section of our year ahead outlook, going into a lot of detail in each country of policies and what are the odds for different outcomes. And I guess globally, the bottom line is that there is quite a bit of uncertainty, not in all countries, but obviously in the US, in South Africa. I would like you to take us through as well. There's to some extent kind of binary outcomes and uncertainty. In LATAM, the big one is Mexico. That one actually has become a little bit easier to forecast. The big change is that one of the potential third-party candidates dropped out of the race this week. So we go back to this, two kind of different, but surprisingly stable in the polls candidates. That still means that a likely continuation of the current government is the base case. Her lead is 20, 30 percentage points ahead, and it hasn't really moved over the next few months. So it's something that people have started to ask to follow the Mexican elections. I really feel that it's not going to become a tradable theme. It's something that's important to watch, but our base case is that the AMLO policies continue, that it's a pragmatic government to some degree. We continue to see kind of a drag on investments as a result of that, but not something that will necessarily change the outlook. And, as you mentioned, Mexico is one of our favorite structural trades out there. We think that, compared to the rest of EM, growth is likely to pick up. The external accounts are in very, very good shape for different reasons, right? We have this nearshoring. We have the remittance flows from the U.S. being very, very strong and, easing at the margin, but it's still a massive positive for the country. So I think that as long as the new administration, the upcoming administration next year, keeps things under control, we should continue to see that. But, let's dig in a little bit into South Africa, which I think is a lot more interesting from the market's perspective.
Yeah, unfortunately, I think South Africa election is going to keep me very busy next year. So kind of polls going into the 2024 parliamentary election really suggest that this is going to be the first election since the end of apartheid that the ruling ANC will actually lose its parliamentary majority. So it's almost a foregone conclusion that we will have a coalition government. But the big question is, who will they form a coalition with? And there has been agreement between the main opposition parties, some of the main opposition parties, basically that they will not form a coalition or any functioning government with the ANC ruling party. And effectively, if they get enough votes, they will form a coalition themselves. So effectively, it really sets up these kind of binary outcomes for South Africa, and all hinges on how much further the ANC support will actually fall below that key 50% level. So, if they're kind of polling 40%, just above 40%, the risk is that they form a coalition with the economic freedom fighters who are, have a very communist history. They're very much into nationalization. They want land expropriation without repatriation. They want to nationalize in the mining sector, the banks. They are very much pro-Russia, and they would take that side in the war. So not only would be perceived as probably negative from an economic standpoint of view, but it would also be perceived that South Africa is very much shifting geopolitically, towards the east, towards Russia, towards China. And then, if we have the ANC whose support drops even further below 40%, towards the 30% mark, it may look like the ANC just really can't form a functioning government, that they wouldn't be able to given this pact. And then you actually have the outcome that the DA could come into power, which is more centrist. A lot of the smaller opposition parties are also kind of economically right-wing. They would look for more private investment into the state electricity provider and also the logistics company. So really it kind of sets up these very binary outcomes for South Africa, and it really all kind of hinges on the degree and the extent of electricity rationing, which is obviously an ongoing concern for South Africa. So lots of risks for the year ahead and lots to keep us busy. That is probably about all we have time for this week. But Alvaro, thank you so much for joining me. If you did like the podcast, do click like and remember to subscribe so you get the latest episode first. Thanks again.